the sectoral and thematic category in the mutual fund space, where a lot of people have gravitated over the past few years and not necessarily had the same experience. And this is understandable because you have the most number of schemes concentrated in this particular category, 250 or thereabouts, if not more. To talk about which schemes have the most AUM, how they have done, and what the path forward should be, what your strategy should be, I'm joined by Sharad Tandon, who's the founder of Invest at Ease. Sharad, thanks so much for taking the time. And in the run-up to this, I wanted to ask you, out of this entire hundreds of schemes in this category, which are the schemes, one with the longest track record, two with the largest assets under management, and where this will essentially tell you where people have gravitated towards?
So, Alex, the first sectoral scheme which I can remember offhand was the UTI transportation. And parallel to that were a few banking funds and the pharma funds. They will have more than 20 years track record. Now, for sectoral funds, in a sense, while it might give you an indication that highest AUM can be a benchmark, but generally it doesn't appear to be. Prudential has one of the funds which is around 15,000 crores of AUM. And generally in the category as a segment on the sectoral funds or thematic funds, we'll have anywhere between 1,000 crores to 15,000 crores or 16,000 crores of AUM on an average. And this will vary depending on the longevity of these schemes. Any scheme which is more than say 10 years, on an average you'll have 4,000 crores, 5,000 crores plus of AUM. And a decent track record for that.
Okay. So if you look at the last 5 years, which is the smallest amount of time, first of all, this is an important question to ask, Sharad. If you're investing in a sectoral or thematic scheme, should you gravitate towards the thematic schemes rather than sector, because it allows you a wider diversification even if you are taking a concentrated bet?
Okay. So which is a fair assumption, Alex, and but generally we need to look at what sort of people or investors look at sectoral or thematic funds. They are typically what we call the high risk category. People who have already gravitated from large cap to mid cap to small caps and now to sectoral funds and the thematic funds. Now, difference between sectoral and thematic is simply one thing. In sector fund, if I have to get out, say, from a pharma fund and get into a banking fund, there is a impact on the taxation and a cost, and I have to judge on it. While something like, say, a manufacturing theme or say a thematic fund of funds, which a lot of fund houses have, the advantage is the fund may itself will concentrate your portfolio in 3 or 4 sort of sectors and rotate that sectors depending on the way he looks the market going forward will be. So it saves you the taxation in that sense and also hassle of timing a sector as a retail investor.
Sure. So, and a lot of people talk about this needing to be within your satellite allocation, which simply puts is anywhere between 15 and 25% allocation, right, Sharad? And yes. So the question though is, within that 25%, is this a part of that satellite, or is your satellite only made up of sectoral thematic?
So, Alex, unfortunately, you know me slightly longer period of time now, and I'm not the bookish one. So, for me, the category of people who look into this sectoral fund should be people who have more than 3 to 5 times of income as income compared to their expense. Now, their risk-taking appetite is more, and depending on
that, give me an example of that.
So, if your expense is 100 and your income is beyond 300 or 400 rupees a month, then you are in a high risk ability to take high risk, and that's where the segment should be. Now there you create a buffer of, typically in a professional life, if you are beyond 45, you are well settled, your responsibilities are more or less taken cover of, so you can take slightly more aggressive risk. So in the category of 45, 46 years plus, you probably can increase that exposure to around 30-40%, but don't go beyond that. In a category which is around 30 to 35 years of age, look at around 10 to 15% and remain somewhere in between that balance, depending on individual investor's risk profile. But don't go beyond overboard. And my sense is this plus your small cap should not exceed at any point of time beyond 55-60%.
Okay, that's fair. Now, to the question where, Sharad, people in the sectoral thematic category, because of misallocation or wrong entry and exit, have very divergent experiences. Some
Yeah.
have absolutely outsized returns, and so that becomes a benchmark going forward as well. That can prove to be a problem. But a lot of people tend to even earn, and this is through a lot of data that has been sifted in multiple studies, that people generally get less returns than what funds themselves give. And that is because of behavior. In the sectoral and thematic category, then, how do you select just 2 or 3?
Okay, so generally the first thumb rule for going into a thematic or sectoral fund is what are the mega trends we are looking in the economy right now or the demography within the country. Now, for example, say if we talk as of today's scenario and going forward next 5 years, what trends will play out? You can play out on data centers, you can play out on the GCC, you will play out on the per capita income growing up, you can play on demographic average age, next 20 years probably income levels going up, and things like that, your hospitality, medical. Now, these are mega trends. If you are opting for something like this and you don't want to time one sector against other, choose a thematic fund for 5 to 7 year horizon. Now, if you are looking at a sector, my only suggestion is to everyone is do a quarterly monitoring of it. And generally, if you look at even last 5 years return, and that data we can discuss at large, Nifty on an average point to point return, say 1st of January, first was closer on 2015, so 2nd January onwards, Nifty has given point to point return as of 31st December 2025, which is flat 10-year record, around 311% to be precise, point to point return. Now, there will be indexes like realty or even say energy, FMCG, metals who would have given abnormally higher return than that in those period of time. But funds like IT, infra, Nifty would have Nifty Pharma would have underperformed the Nifty, not by large, but say by around 30 to 40 percentage points out of this 311. If Nifty has given, say lowest is Pharma at around 270. Now, this is point to point lump sum return we are talking. But if you convert this for a retail investor in SIP, now the SIP investors shows a slightly different benchmark. And if you look at any of the sectoral funds which have more than 10-year track record, and we filtered around more than 25, 30 funds on that, and then we put a filter which are more than 2,000 crores of assets, things like that, broadly around 20 odd schemes if you look at, in last 5 years, if you are doing in those exposures, you have outperformed Nifty by leaps and bounds. And I can give you example of it also if that's easy for people to understand.
We're putting that data on the screen. So everything from a UTI transportation logistics to your ICICI Prudential export services, your Nifty, your Nippon India's pharma fund as well, despite the pharma as a index underperforming, has just about kept pace, I think, more or less. Yeah, 17.79% over 5 years. That's better than a Nifty return on the TRI by as much as 0.5% or thereabouts. So, Sharad, the point is well made. Just to live and to conclude this, you're essentially saying that you can go for this. It is an aggressive strategy. Bear in mind that you should have a long-term outlook and you should not have more than an allocation of 25% in your portfolio depending on your risk. And a maximum of 3 schemes in your opinion?
So if you do beyond 3, you are running a flexi-cap fund.
Sure.
And the only word of caution is this data, the 2 tables which we are talking about, one is the indice level performance, one is the scheme level performance. Now this also in a sense put to rest one debate. Is the passive index better or actively managed funds better? In a sectoral category, hands down, the actively managed funds will do better than the indice passive funds.
Yeah, okay, so that's a strong argument made. Sharad, we'll have to take that debate forward into the next chat that we do, because there are instances where an exception to the rule can be argued. There are instances where you can say that by and large, indices, at least in the recent past in certain sectors, have performed better than the active fund. But we'll keep that for another day. Thanks so much for taking the time.
Thanks, Alex.
That brings us to the end of this edition of Your Money Matters. Thanks so much for watching. This is NDTV Profit.